Good morning. Welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts. It is, of course, Wednesday. And, this is really kind of one of the interesting points that we talked about yesterday was about the markets, fixed income, the dollar, and the interplay between all three of those issues. Yesterday we saw the markets here sell off just a bit and really a little bit sloppy yesterday, but this is after markets have had a very nice rally back from the lows that we saw following the September peak. And we basically kind of V-shaped here back to the previous highs of September. Markets, though, returning back to very overbought conditions on a short-term basis. The money flow buy signal very extended here, suggestive that, if we get some more sloppiness here over the next few days, we could see that signal turn down. That would also suggest potentially more consolidation, more correction here over the next couple of months. Now, what could fuel that, right? That's the question. Well, one of those things is, of course, the amount of speculations that we see in option contracts. And that's back to where it was previously back here in September, where we had retail investors chasing options contracts, really getting very over their skis in terms of speculation. The other side of this coin, of course, is also talking about fixed income. We said yesterday, watch what's going on with 10-year treasuries because the bond prices were bottoming right along the price of the 200-day moving average. Very nice reflexive recovery yesterday, and we're very close to triggering a money flow buy signal on bonds. Now, this suggests that typically what you're going to see is a risk-off rotation, money coming out of risk assets like the S&P, moving into safety assets like the U.S. Treasury, right? And so what else goes into U.S. Treasuries? Well, that's dollar reserves. One thing we talked about in Tuesday's Technically Speaking post was the rise in euro-dollar positioning, which is basically money flows from foreign countries and reserves into the U.S. dollar. So as money comes into the U.S. dollar, that also flows into treasuries, and we saw the U.S. dollar also pick up yesterday. Big pickup in volume here. We're starting to see this recovery and very close to a money flow buy signal here as well. These two things combined, stronger dollar, lower yields on bonds, suggest that we're very close to having a correctional phase in the S&P 500. Also, this rise in the dollar would also affect international investments as well. So we're starting to see, after a very big run in emerging markets, as well as we saw the same thing with international stocks, a big run here, very, very big money flows. Both of these positions are very, very extended. Those are negatively affected by a rise in the dollar. So keep a watch on bonds and the U.S. dollar. If we begin to see those turn up in earnest, that's going to suggest that, first of all, we're going to see more weakness in the international markets, as well as potentially weakness in the S&P, because there's been a very high correlation as of late between the dollar weakness and the S&P, and we're likely to see that reverse. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you tomorrow.